Hey everybody, Eric here, and I am super stoked to have Bryan on from Alpha Trend. So first off, welcome to the channel.
Thanks for having me on here, Eric.
And just so you know, whenever you see me looking down, I got my little notepad here because I am partially an idiot and I forget things. So I like to write stuff down. But the reason why I came across you, first of all, is there's a couple people that I interact with regularly on Twitter, and one of which is Jake from TrendSpider.
Right.
And as soon as you start talking technical analysis, your name inevitably comes up in that web. And I also wanted to say very quickly, thank you for sending me a copy of your book.
Yeah.
I have literally been enjoying reading that a lot. I have actually quite a few questions on that I'll get to in a little bit, but
Cool.
I want to start with a little bit of level setting with you, because the way that my channel is set up is I think that the financial industry in general has a lot of inauthenticity. And one of the things that I've always really benefited from when I was starting trading and whatnot is I had a mentor that just spent some time with me and kind of just shot it to me straight.
Mhm.
And in that, I learned a little bit about technical analysis, but one of the things that I'm known for on my channel is generally a lack thereof. So I thought, what better person to connect with? Because one of my favorite things to do on the channel is to tie into different skill sets. And obviously, you have a very technical skill set. And I think that exploring that a little bit offers a really, really cool paradigm to the rest of the audience. Because like I said, for me, I use some, and I'll get into a little bit of what I like to do, but I'm more interested in what you like to do. So I thought a great way to start would be, if you don't mind, I would love to just get an understanding of your relationship with the markets kind of at large. So maybe when you started in the markets and what's that evolved into over time.
I started in the markets at an early age. I think I was, 12 or 13, and just kind of used to hang out with my dad on Friday nights back when Wall Street Week was a big thing with Louis Rukeyser. I don't know if you know that name, Eric. It was a Friday night show, and I would, was a kid who wanted to hang out with his dad. So I would sit there and watch TV with him, and he'd always have Wall Street Week on Fridays. That was kind of his thing. So they talked about the market. So I started, asking them questions here and there once in a while. And then there was a company in the Boston area where I grew up at the time, called LoJack, and they had just gotten a contract with the state police. And I saw it on TV and basically got lucky. I said to my dad, hey, can we buy some of this stock? And it was, $5 a share. He said, sure, I'll put up, I had money from caddying, newspaper routes, and all that stuff you do as a kid to make money. And he said, well, we'll buy 1,000 shares. And, he gave me leverage, basically.
Right.
A couple months later, the stock went to $10 per share. And I had 1,000 shares of it. And I was 13, 14 years old. So, I thought, hey, why does anyone work? This is the way to go. That's what I want to do, is be a trader. And I am a trader today, but it wasn't just as easy as it seemed from that trade. There's been a lot of up and downs, in between that got me where I am today. That was just my first introductory, kind of got the needle in the arm, for a lack of better analogy. But I mean, it's true. I was hooked, and I really, so I, later on when I was 16, 17, I kept my interest in the market and would go to the library and read, newsletters and that sort of thing. One was the Cabot Market Letter. There was Value Line there, and I would, look at these things and dream of all the money I was going to make. And between reading mafia books, I like to read those, and stock market books when I was a kid. Unfortunately, I'm a trader, not a mafia guy.
Yep. Good career choice.
Right.
Most of those guys are in jail or dead. So
yeah. So that really was, it called to me. And so I went on to become a retail stockbroker in Boston. Okay. And, as I like to tell people, it was basically a glorified telemarketing position. I didn't know what a broker did. I went to college. I didn't take college as seriously as I should have. I was a solid C student, basically, and not really.
Just get degrees.
Just get a degree. And I have mixed feelings about whether had a better time in school or life afterwards. And I think I made the right call, just, finding the balance.
Yeah.
Although, I think a better balance would have been bees and a little less of the weekend activities, but that drifted into the weekdays. But on to more serious topics. So the retail stockbroker was basically a telemarketing
Kind of
position,
like
and
sales.
it wasn't what I wanted to do.
Right.
It was really good that I learned a lot of skills, sales skills, dealing with people, being a retail broker. So and I kid around when I say it, but it's actually partially true that I got to practice with other people's money and
Right.
make mistakes with their money
Right.
before I went and became a full-time trader myself, which
Right.
was 1993. I left. So 91, I graduated college and went, to work at Lehman Brothers, moved out to Denver, worked for a company called Dane Bosworth. And I think it was 93, I went and became a full-time trader. I opened my own office, actually, day trading office in Denver with a partner. And kind of, had that office for a little while. I ran a hedge fund for a little bit, which never really amounted to a lot. I just was not, it didn't have the asset base, and I was a little impatient. So, I started with another company called MarketWise, where I created stock trading courses, technical analysis, and just about level two and trading in general. And then left them about 14 years ago. I started and have been trading full time and just trading. And then Howard Lindzen, who started StockTwits, approached me once and said, "Hey, do you want to start a newsletter? You've got a good YouTube following and that sort of thing, and you've got good information. Do you want to start a newsletter?" I said, "Yeah, but I don't feel like dealing with all the customer service
Yep.
stuff." So he said, "Don't worry about it. We'll handle that for you." So Alpha Trends was born out of that as
Cool.
a subscription product,
Okay.
and I still do it to this day. I don't market it heavily or anything like that. I kind of let people organically find me, and if it fits, it fits. If it's not, then I'm not going to beat anyone over the head for it. I'm not into sales. My passion is the market, and if you follow me on Twitter, you see that's basically it continues to be my passion. Now, it hasn't always been, it's a love-hate relationship, and
Yep.
the more experience you get in the market, the more it's a love experience, because you realize that you can deal with the market on your own terms. You don't have to chase things. It's okay to miss trades. You just become more patient, more tolerant of market moves. My wife likes to say it's, life's too short to drink bad wine, and life's too short to take marginal trades as well. There's just no longer do I sit there and just like Jones for trades and look to take a trade because I feel like, hey, I'm a trader, I have to trade something. Where's the action? Instead, it's just more methodical, process based, focused rather, and managing risk is the most important thing.
I, I I don't know how you read my mind. I literally was just writing down some notes from your book, and the very first bullet point, I literally just wrote this was risk management,
Right.
because I love that you talk about that in your book. And it's something that my mentor spent a lot of time explaining to me, because you have people like Warren Buffett that has his rules, and his,
Right.
first rule is make money. Second rule, don't forget rule number one. And
Right.
he always respectfully disagreed with that for the purpose of traders. Obviously, Warren
Right.
Buffett, more of an investor mindset.
Yes.
Um, and he always instilled in me that the number one job of any active market participant is risk management. That's your, very first thing. And I actually love that you talked about that very early in the book, because one of the things that I think about technical analysis is a lot of folks either are non-committal in their forecasts, or they always have a reason why, the forecast didn't work or something like
Right.
that. And it to me, it feels like it misses an element of reality. And the fact that your book started with that really set me on the right tone in my mind for reading the rest of the book, because I think the fact that you talk about that early is super important to me as a trader. And obviously, I think that that's a great highlight for a lot of folks that are interested in the market, whether it's via TA, investing or whatever.
Right.
I had a couple questions about your kind of career progression. This is kind of a selfish part of these conversations because I literally am just very curious about people.
It's your conversation.
Yeah.
You get to call the shots, right?
Well, I try to make sure that I integrate, because I get questions that some, the folks send in that they want me to go over with you and whatnot, but I always make sure to add a little selfish time in there because some of this stuff is really cool to me. So for me, I started trading when I was in high school, and I started with, buying and selling stock, but essentially I've been retail trader side the whole time.
Right.
So when I talk to people like you that have had some mixed experience, I find that fascinating to explore some of that. So one of the first questions I wanted to ask you is when you went from your time from working as a retail stockbroker and then you opened that day trading office,
Yep.
what was that transition like for you? Like when you were a retail stockbroker, obviously very focused on sales and getting people, to place trades and whatnot. And then I'm assuming when you went to that day trading office, probably a different focus. I'm curious just a little bit about what that looked like for you.
Right. So it wasn't straight to my own office.
Oh, sorry.
But I didn't clarify that earlier. What happened was I had used to read get the news, the print IBD, and in the back page there was always an advertisement there that said, day trade buy power. Get 20-to-1 leverage.
Right.
To put $25,000 down, and you would get 20-to-1 leverage. So that appealed to me. I was thinking, I don't have enough money to trade full time. You've got to think This was 1993, and I was 20, 21, 22 years old. Is that right? 26, whatever it was. But the point is that, I had a young family, I had a mortgage, my wife wasn't working, and I had about.
Oh, so you already had a family at that time.
I did, yeah.
Man,
yeah.
So the pressure's on.
The pressure was on maybe there was something in my brain that wasn't connected to recognize the magnitude of the risk.
That's crazy.
Because what I'm going to tell you next, I wouldn't suggest anyone do. I had this job as a broker, and I had saved up maybe about $19,000, and I was just couldn't wait to get out of there once I had my $25,000.
Right.
And this was about this time of year, around Christmas, and I guess it was 1993. And I was trading this stock called Shannon Pharmaceuticals.
Okay.
And Shannon Pharmaceuticals wasn't a pharmaceutical company at all. It was a skin cream that had this miraculous anti-wrinkle property.
Nice.
And they had all these doctors, that came on the payroll and, made it seem like a legitimate story. So where this company's going by those words. Yep. So I had run my account from, $19,000 to $28,000 in a 2-week period. I was like, that's it. I'm ready to quit. I'm done. I'm gonna go. So I then took a day off work to go skiing. I called the office to see where Chantal was. This was a Monday. I took the Monday off. And the person who answered the phone, I had 1,000 shares of this thing. It was, let's say, $23 a share. Mm-hmm. And she says, it's $18.50. I was like, no, you get the symbol wrong. It's probably like 28 by now.
Right.
It does nothing but go up. Anyways, Barron's did a hit piece on it over the weekend and basically said, the company's a fraud. This thing doesn't do anything for wrinkles. So I just said, listen, sell my stock right here, right now, which was the right thing to do because it was a fraud. And I was lucky to get out $15 a share when within 6 months, it was a $2 stock.
What was your basis?
I had been trading it, so I considered my basis basically where it closed on Friday, which might have been $23 per share. So I'd lost $8,000. So it brought me back under that $25,000 level, and I was crushed. I had already put in my notice that I was quitting, and I didn't know what to do. So I took a cash advance on my credit card to make up the difference. I wired it into New York,
Oh my
and
God.
started trading. And, I was scared to death, really, of
Right.
losing any money.
Yeah.
And they say scared money never wins. And scared money doesn't win big, but I was able to, plug away, and I wasn't making real money at all. I mean, I was like making, $1,800 this month, $2,600, but I was making
Right.
money. I had a really, I mean, my first house cost, I think it was $79,000. So my mortgage was like less than $1,000. So it was, it worked. Thank
Right.
God.
Right.
But I realized I'm never going to get ahead with this, even with this leverage, because
Right.
one big mistake, I'm just done. I'm
Yeah.
going
You
out of
get
the water.
you,
I've got no backup plan.
right. And you got the family now. That part to me is just, I really tip my hat off to you, because
Well,
I get, like looking back, it's kind of like, was that right? But it's just to make that bold of a move, I think deserves some sort of recognition, because I feel like at some point you have to trust yourself, and you got there a lot earlier than I did. Like that's nuts to me. That's awesome.
it is nuts, and that it worked. Fortunately, I can
Right.
laugh about it, and I wouldn't suggest anyone does it. And again, I had a very strong. That's why risk management, Eric, is so important to me. I've
Yeah.
been on the brink of disaster, and I've had bad drawdowns in between, obviously, in my 30-year career, but never bad enough to put me out of business. And I feel like a lot of people out there are putting themselves in positions where they just trust the market can do nothing but go up and everything comes back, and they would never cut a loser. How would that work? It's just not a part of some people's process. Anyway, so the company that I worked for, they were called Generic Trading, and I was trading remotely it was on a 24K modem. And then I remember the upgrade to the 48K modem was just amazing.
That's awesome.
And then so I went to New York and talked to the owners of it, Ron Shearer and Meyer Hoffman, and said, listen, there's nothing like this in Denver. Would you want to back an office in Denver? And they did. So I got my branch manager's license, opened an office, ran it for a couple of years, merged it with another company, and worked with them. That was MarketWise was the name of the company, for a period of, I think, about 8 or 9 years. And that kind of just, ran its course. And fast forward to, just sitting down, trading for myself, writing notes and doing, YouTube videos for free with no intent of doing anything with it. And then, like I said, Howard approached me and said, hey, you want to start a newsletter? So that was that.
Right. Man, that is just so crazy to me. The other thing that I find fascinating about these conversations is, I have been trading for a little while, right? I've been trading for over 14 years now.
Yeah.
But to talk to people like you that have, like, no kidding, like you talking about the modems is what just inserted this in my brain. It's
Right.
like people like you have, like, just this very fascinating perspective about the evolution of the markets, which is another question that I'm going to ask in a little
Sure.
bit, but I have another background question to ask you. And what I'm curious about is, so you did this day trading bit for a while, and you were kind of explaining how you ended up moving over to the hedge fund and managing a fund for a little while.
Yep.
And you were mentioning that wasn't necessarily your end all be all, but I
Right.
am curious, while you were managing the hedge fund, I'm assuming you had a very different strategy that you were generally deploying compared to when you're trading, like, now as an individual retail trader. Is that true or no?
Not really. I mean,
Okay,
so
interesting.
it was, I started out kind of just day trading. This was actually, you've got to remember, this was during the SOS period as well. SOS was still the way you executed orders.
Right.
And then they started coming out with the ECNs. The first, real big one was Island, and then Ready and Archipelago. And those gave the retail trader the ability to get in between the spreads that back then were, quarters and eighths. They were fractions, not decimals.
Right.
So those gave us a perceived advantage. And if you look at it now, you'd be like, why is there a 25-cent spread in this stock? This is insane.
Right.
We're used to pennies now. So that kind of, progressed towards, an evolution of my style.
Okay.
The sows, the speed of sows wasn't so important anymore. One of the most influential books early on was Hit and Run Trading by Jeff Cooper. And there were some strategies in there that I learned that really helped me kind of see the market for swing trades. And I started expanding my time frame into, instead of just being a day trader, days and sometimes weeks. And, learning to put my thoughts of what the company does. I was trained as a broker that, fortunately for me, when I worked at Lehman Brothers, I had a senior broker I worked under, and he was into technical analysis. So I picked up a lot from him. And the way that he would pitch stocks was he would find earnings surprises, but it had to have a good chart. If it didn't have a good chart, forget about it. And then I would kind of have to, help develop a story to sell to a customer, because a customer isn't going to buy a stock because it's breaking out on huge volume,
right,
and the things that we take for granted now. Instead, it would have to be, hey, they make this product, their sales are this, the earnings are that, estimates are going up, value line says this, our analyst says that, and creating the pitch and creating the story around it.
Quick question on that.
Yeah.
Sorry, were most of the people that you were pitching to, were they more investors where they were like holding for longer than a year, or were you guys managing folks that were actively buying and selling, more frequently than that?
Well, you tend to find the people that are geared towards your personality. So if I pitch somebody on the phone who is a buy and hold investor, and I'm talking to them about this. We think this is our 3 to 6 month target is the way we generally, mention them. Our 3 to 6 month target is this. They'd say, well, that doesn't interest me.
Right.
Then you'd figure out, and one of the it's not nice, I guess. One of the things that I learned at Lehman was that a successful phone call is either you get a yes or they hang up on you.
Got it.
And I didn't really want them to hang up on me, but it was, I'd get pretty firm no's. You'd have to just keep going back at them until they really became clear. No, this is not what I do.
Right.
Okay, fine, thanks. So you would, your customers would kind of be representative of the style that you presented them.
Okay.
And a better salesman would probably try to be all things to all people and pretend, hey, we'll hold it longer term. But I was more interested in the market than I was in being in sales. So I gave it to them straight. Here's what we're looking for. And that was, if I had to do it the other way, in fact, one of the firms that sponsored me as a broker, they wanted me to sell insurance products. And I said, listen, I have no interest in selling insurance. I'm not going to sell annuities. Yep. And they said, no, you have to sell annuities. I've scheduled you to take your test, in a month. So, well, I'm not going to study for the test. We'll see how it goes. And I failed the test because I was stubborn. I'm 22 years old and I already know everything. So why would I want to do this?
Yep.
But the point is, I was a stock guy, and I'm not going to, I couldn't authentically sell an annuity to someone.
That's awesome.
So he signed me up to take the test again. I studied for an hour and failed it. Third time, he said, listen, you really don't want to do this, do you? I said, hey, you finally got the hint. Quit bugging me. No, we're selling stocks. I'm a stockbroker, not an insurance agent.
Yeah.
So that was just a little aside there. Sorry.
That's awesome, though. I'm glad, because there's so many people, especially when you realize what you can make on insurance products via commissions. A lot of people are like, yes, sign me up. But it's like you're saying, they kind of sell their souls in pursuit of a few dollars. And I actually really respect the fact that, they dangled money essentially in front of your face. And you're like, no, it's not what I like to do. I'm going to keep doing that. So I love that. I think that's
cool. Thanks.
So then you were talking a little bit about the broker that you worked under. and he was starting to introduce, or I don't, maybe you were already familiar with technical analysis at that point, but that's really what I want to understand next is when did you find technical analysis and when did that become the thing that appealed to you?
The summer of 1991, when I graduated college, as I said, I used to look at these newsletters, and there was one newsletter. It was the Cabot Market Letter,
Okay.
and in that they said they were talking about this company that it was called Advanced Polymers, and it was things that go into tubed products that make it last longer. The flavor lasts longer in gum or in toothpaste. It will hold things better. It was a polymer that binded them together, was the story behind it. It had a great story. And I remembered reading, we like this stock if it gets above $8 per share or whatever the price was. I was like, why would you want to buy it higher? That doesn't make any sense. Why not buy it at this low point? And then I looked at a chart and it was just clear as day. I mean, the chart just spoke to me that it just kept coming up to that $8 level and couldn't get past it. Mm-hmm. So yeah, it can't get past 8. Well, if it gets above 8, well, there's clear sky. And then I started to say, okay, I need to learn about this technical analysis stuff. So that summer I picked up, the first book I picked up was by John Murphy, Technical Analysis of the Futures Market, which, it applies to stocks. Then I read the better book, which really has had the huge impact, which was Stan Weinstein, Secrets for Profiting in Bull and Bear Markets. And that one, I devoured that book, and that one just spoke to me big time. So I had a little bit of knowledge going into that role under the senior broker. I was getting paid $5 an hour for qualifying leads. And then if I opened the account, at least a $10,000 account, I would get $100. Okay. And so I was making peanuts, right. But I was getting great experience because I was working for a guy who was, he was $1 million producer. He right. $1 million of commissions a year. So he was top notch, and I learned a lot there. I didn't stick around long because I wanted to go be a broker somewhere else and rush the prize. I was in a hurry, which worked out great. So he was, he would get the daily graphs, which is MarketSmith now. Daily graphs had printed products called, they were called daily graphs, and there were printed books. One was the blue book, which was the New York Stock Exchange, and the green was the NASDAQ and Amex. And it was, it would come every weekend, 200 pages, 4 charts per page. It had, all the information of sales and earnings. And I would just spend, all day Sunday, as soon as I got those, I would just spend hours going through them. And then, they were 4 per page. I would cut them out, cut out the ones I liked that were interesting. I'd go down to Kinko's and put it on 400% and make it a, full-size page so I could study and mark notes on it and get ready for the week ahead. So that it really just, it just spoke to me, and it made so much sense because I knew when I was a broker, I was selling the chart, but I had to, that's what I was selling, but I had to package it with a story. Right. I had to put some sizzle in it because people would be like, well, I broke past this resistance on heavy volume. You lose them as soon as you say that. Right. It's different today because technical analysis is much wider known and accepted and seen everywhere these days.
Yeah, definitely. But I think that also, I don't know if it was purposeful for you or maybe subconsciously, but even as you're talking about a lot of this technical analysis that you were doing, maybe, you were doing some of this fundamental research to support it, but you're telling me about these different companies and what they produced, what it was supposed to, what value it was supposed to provide. So it even seems like, you might focus more heavily on technical analysis, but it does seem like there's still, a bit of qualitative understanding that you used, to bundle this whole thing up, which I think is really interesting. Do you think that that's something that you still do today? Like when you're trading, whatever you like to trade, do you still have that level of fundamental understanding as well, and you're kind of driving with technical analysis, or would you say that you're kind of more of a pure technical analyst?
Yeah, I don't look at, I sometimes I'll look at a company's website if I just want to see what their product physically actually is.
Right.
But most of the time, I'm familiar with what the company does. I mean, I'll look in it. I'll read the paragraph description.
Right.
I'll look at their, and that's the nice thing about MarketSmith charts is that they have what I think are the most important things. The two most important things are whatever the company is, are they increasing revenues? Whatever they sell, are they selling more of that stuff than they did in the same quarter a year ago? And is that increasing sequentially as well? First quarter, second, third, fourth quarter. And not only are they, increased revenues, but is it showing up in the bottom line? Are they making more money?
Right.
Are they selling more stuff? Are they making more money selling that stuff? That's basically what I need to know about the company. And then if the chart supports it, it gives me that little extra confidence that
right.
I can go into this stock a little bit heavier because they have a real product. They have a real company. It's not some fly-by-night little biotech stock that is in phase 2, and it's got this wild chart that, it can go up 80% in a day. But if you look at every single day, if you look at the NASDAQ losers, in the top 10, there's 2 or 3 little biotech stocks that are down 30, 40%. So it just gives me a little bit of confidence to say, hey, it's a real company. And I understand the psychology of what drives fundamental investors. I'm not necessarily buying the story myself, but I understand that the market values these things and they do have a real product. So it makes sense that I can get involved a little bit heavier, in terms of my risk unit and give me the confidence to hold overnight. And then I want to know, are earnings due over, tonight? I don't want to hold it. If they are due in a week, maybe I buy it for the run up in front of earnings, and just basic fundamentals, Eric.
That honestly, I feel like that came across in your book. And that was something that I really liked, because a big frustration that I have is I think retail traders in general face an uphill battle, no matter what.
Yeah, definitely.
I mean, even down to, what we can transact at, we can get to, 2 decimals, whereas market makers go to 4 to 6, depending on where they're at. So there's just a lot of structural, barriers that we already have to deal with. And a very frustrating narrative I see is when people are like, oh, this is better than that. Speaking fundamental better than technical, technical better than fundamental.
Right.
And I've always been a huge advocate of why pick. It's not a binary decision. You can, exactly like you're saying, you can use both. Do you need to, weight them exactly the same? No, you do what you're comfortable with. But I love that you integrate some, other parts, no matter what that is. And I think that there's just a powerful message for people, because a lot of folks, might be chartists, but even like you said, understanding what the company sells just helps provide a little bit of context.
Yep.
And that leads to a follow-on question. And this is just out of general curiosity. If you came across a chart that you really liked, but the company's description, they sold something that you just don't believe in, or that, you didn't really think much of, how do you treat those instances?
I'm in the market to make money, not save my soul, or win points with any investing committee, or be judged. The market's a selfish endeavor. I can go beyond that pretty quickly. Unless it's something egregious that just doesn't make sense to me. And I honestly can't think of an example. Your so-called sin stocks, sell guns, they sell weed, they sell booze. Doesn't bother me. There's products for these. They're part of society. The stock is going. I see it.
Right.
Why wouldn't I get involved?
Right. I love that. I truly identify with the same thing. I went through an interesting phase. I was trading like a couple company like Phillips 66, and I was trading, just some stuff that falls close to those categories. And I was like thinking through how I felt about it, but I pretty much arrived at the same conclusion a while ago. Whereas there's a market for it. People make their own choices. This looks good at the time. I'm gonna trade it.
All right. Yeah.
Cool. So that's really helpful to understand a bit of just your general context. Like I said, I think that you bring a really fun perspective to to the discussion, because it's fascinating for me to understand more about your approach. So I want to pivot real quick to just a little bit more about your general technical analysis approach. So there's a couple things that I picked up in the book that really just seemed to cross through to me. One of which was the concept of multiple time frames. So if there was like a 30,000 foot view summary, if you were to characterize your general approach to technical analysis, what does that look like?
Yeah, so I mean, you hit it. It's trend alignment, and what that basically means is, at any given day in the market, we could be in a bullish environment or a bearish environment. We've had, off of the COVID low in 2020, we've had this phenomenal bull market, but along the way, there's been a couple scary declines,
Right.
and periods of, let's say, 3 to 6 weeks where we've clearly been in bearish environments. And if you're buying stocks, you're losing money. Or if you're buying some of these stocks that are yesterday's winners, Peloton, Zoom, PayPal, the list goes on and on. A lot of these big tech names have been destroyed here in just the last few months.
Right.
So when I look at those, I look at the big picture and say, hey, it's in a primary uptrend. So to me, that becomes a candidate for a purchase. I don't want to buy it after a stock has already made a move, a FOMO move, fear of missing out. Hey, it's run, I got to get on board. And one of the things that really is curious is that whenever I, interact on one of these Twitter spaces, or if I do a webinar with people who are asking questions about a stock, they almost always ask me mainly about two types of stocks. One, the stock that's up 10, 15% in the last week, and say, do you think this is a good buy here? And say, no, look where it's come from. Or they ask about Peloton or in Zoom and say, does it look like a good buy down here? And they've been trained by the dip, but they bought the dip at 10% down, 20%, 30%, 40%, and here we are 60% down. Dip buying is not a strategy in my mind. So what we want to do is buy strength after a dip. A true dip is a stock in an uptrend that pulls back to a level, finds support, and resumes that uptrend. If instead the stock pulls back, breaks below key support, breaks below moving averages, those moving averages start to roll over, tells me we're in a different phase for this stock. The sellers have regained control. It's no longer dip buying. You're buying into the abyss. You're buying from institutions who are liquidating millions of shares and thinking, that it's yesterday's news, and using yesterday's logic that the stock is in an uptrend and the bounces have been strong, with today's reality that it's a broken stock.
Right.
So what I want to do is I want to focus on the stocks that are in uptrends, and real simple. I mean, if you look at a daily time frame, you could look at a 20 and a 50-day moving average. If the 20-day moving average is above the 50 and they're both rising, to me, it's in an uptrend. It's innocent till proven guilty. But it doesn't mean I can just buy it anywhere. Again, it might have just run 15% in the last 3 days. I don't want to be late, because a normal pullback from, normal correction could shake me out at a big loss. Instead, I want to see the stock that ran up 15%, went sideways for a day or two, and then begins to pull back 3 or 4 days, and it maybe retraces half of that rally that it showed. I don't want to buy it as it's pulling back, because again, I don't know if this is the time it's going to just collapse. Yeah. So as we start to look at shorter term time frames, and you might look at, for instance, a 30-minute time frame of the last 30 days, you'll see that it's come down and it starts to turn sideways. And as it starts to turn sideways and stabilize, it might be stabilizing on that 20-day moving average, or at a 61.8% retracement, or at a volume weighted average price from the prior low. If there's some technical reason to be interested there, then I'm aware of it. And I look at the shorter term time frame, and I look at it and say, okay, it looks like the battle is being waged here between the buyers and sellers. But the
Right.
sellers had taken control for a few days. Now it's turning sideways. If we go back to technical analysis 101, the first rule is, one of the first rules is a trend once established is more likely to continue than reverse. So if it paused, and as soon as it starts to make that first little higher high on the shorter term time frame, it emerges out of the price correction and then a time correction. It makes that first higher high on the shorter term time frame. It's now in alignment with the higher highs and higher lows on the daily time frame.
Right.
That's where I want to get involved and set my stop underneath whatever the most recent relevant higher low is. So if you look at my Twitter, I never mention stocks without saying, here's where a worst case stop would go. It's always, again, back to what you picked up on, first thing you said is it's always about risk management. You can't get hung up in your analysis and say, I think I'm right. Forget the market. I'm going to buy more. You have to say at this point, if the first point it makes that first higher high on the short-term time frame after the pullback, that's where the momentum is now in alignment with the longer-term time frame. Now I'm looking at an emerging trend defined by higher highs and higher lows. So if instead it breaks higher and then pulls back and makes a lower low, well, my definition of trend is no longer existent. Right. So why on earth would I still want to hold this stock? Because I'm stubborn, because I read their annual report and I spent 10 hours researching this stock on the weekend and I feel like I have to make money in it. That's part of the danger of doing too in-depth of a fundamental research. You start to feel married to it.
Yep. Yeah, I think that's something that I talk quite a bit about too. Is it was funny when I don't know, was trading for a little while early on, I would see these people talking about like emotions and ego. And to me, it was always just like something that older dudes talked about because, for whatever reason, I didn't understand it. Because obviously when I was 22 in a rush to make money, I didn't have an ego at that point, obviously. And, just it's interesting that you mentioned that though, because I think that something I find fascinating is the markets by definition are in uncertain space, and people try to find certainty by collecting more data points. But what they seem to not totally understand is sometimes it's exactly like you're saying, they kind of just create this narrative for themselves that doesn't necessarily solve the uncertainty. The uncertainty is still there. You just have more data points that you may not believe in. So that leads me actually to another question. And this is actually a genuine question that I've had for a long time for technical analysis. In general, there's a handful of tools that I like to use. I like to use linear regression channels or standard deviation channels of some sort, maybe Bollinger Bands, and then typically moving averages, maybe fibs sometimes. But overall, pretty limited. I do like to use volume and maybe an oscillator just to glance at, but not too heavily.
Right.
Something that I've always found to be difficult to understand is the idea of market timing, because obviously I've read a bunch of white papers on the behavior of individual investors, and essentially a very difficult time that traders have predicting timing in any capacity. And when I was reading through your book, I actually really liked the way that you use multiple time frames, because it's not so much that you're, at least this is my interpretation.
Sure.
It didn't seem so much that you're necessarily trying to predict much of anything. You're mostly seeing what's happening and what's most likely to happen thereafter. And then you're always still using that stop to kind of catch yourself. But I'm curious, when you're applying your technical analysis to charts, is that close to what you're doing just in terms of trying to understand what's happening and finding the best way to interact with that? Or is there more of a predictive paradigm that you're applying?
Predict is too strong. I like to anticipate. I like to anticipate different scenarios. And in that, if I predict, it means I think I know the outcome. Right. But if I anticipate, at least this is how I differentiate it. Maybe I'm splitting hairs over the terminology. But if I anticipate, and if I look at the stock It's in the uptrend. I missed that first move. It goes sideways for a day or two and it starts to pull back. And then it starts to stabilize a little bit. That's when I really become interested in it because I say, okay, the primary trend is higher. It was up on big volume. So I look at, my main tools are, time frames. First, I want to identify my candidate on the bigger picture, the daily time frame. And then as it begins its pullback, I look at a shorter term time frame. On the daily time frame, I have, as I've mentioned, some simple moving averages. I look at volume. I want to see the volume expanding in the direction of the trend. I want to see relative to that, the lighter volume as it pulls back and finds, as it settles into, let's say, a 20-day moving average or a Fibonacci or the volume weighted average price off the prior lows. It starts to settle in and show signs that the sellers are losing control. The buyers are stepping up a little bit. I want to think, okay, in terms of supply and demand, this, if shorts were shorting this because they thought it was up too much, they realize the bigger picture is still higher and they're most likely going to look to be covering. That adds a source of demand. Right. If there was a big fund that started, they have 5 million shares and they wanted to take a little bit off while they can, they sell it down to the 50-day moving average. So once it gets to the 50-day moving average, they'll stop selling because they don't want to hurt the stock. In fact, they might start, put a bid in there to support their position. So I'm trying to think of who are the players? What are they doing? How would I feel if I was short? What would I be doing? What if I was long? What if I was, as I am in cash, what's the right way to look at this? It's stabilizing at a key level. It's starting to show accumulation on a shorter term time frame. Now, if it is truly in an uptrend and I'm buying it as it emerges after that pullback, it should go on and make a higher high. But if it doesn't, then there's maybe something wrong here. But even before it gets to that higher high, let's say it pulled back from 25 to 22, and I'm trying to buy it at 22 and a half as it breaks that near term little resistance. I want to know if I'm wrong. If it goes below 2180, I'm out because that's the most recent relevant higher low for this consolidation. And that breaks the definition of trend. So it's if then. If it breaks, I'll buy it and I will continue to hold it. But instead, if it breaks lower, I need to get out because I'm a technical trader. The definition of trend is higher highs and higher lows. We broke that definition. What the hell am I still doing holding this stock? I'm not being true to the process.
That's pretty powerful, I think, to be honest. I think that a lot of people, when things, Mike Tyson, said it the best, every day's a play until they get punched in the mouth. Yep. And as soon as, people see something, diverting from the original trade hypothesis, it seems really common to rationalize it. Oh, this is because of this or because of that, and it'll revert. It'll be better. It'll be okay.
Eric, not to interrupt you, it goes back to what you were just talking about, the fundamental analysis. I like everyone, learn my lessons the hard way. When I lose big money, that's when I've lost learned these lessons. And what I know is in the past when I've had big losers, and if I'm not familiar with the story, what do I do? I'm in a stock. I don't want to sell it. I'm stubborn. So I start looking at the news. I start pulling up research reports. I start trying to find some shred of hope to hold on to because I know that price isn't it anymore. So I, start to justify it. And it's been a long time since I've been in that position. That's a great habit to get out of as quick as you can recognize, you're holding a loser and you're starting to justify why you're holding it. That means sell the stock. That's all it means. It means that it's arrogant to go in and think that you're going to be right. So part of your plan has to be that risk management saying, I could be wrong and I don't want to lose my money. I don't mind losing a little bit. I still don't like losing. I don't like, people say love your losers. I don't love my losers.
I agree with that wholeheartedly.
I don't like to lose, right? We're competitors. We want to achieve at high level. Losing sucks. It's part of the process. And you realize that. And sometimes the best way to have that point driven home is that you do buy the stock at 22 and a half. you sell it at 21.80, and you look at it the next day, it's $18.50. And then it feels good. Then you like your losses a little bit
Of
better.
course,
At least
yeah.
I'm not the dummy still holding this thing. I had my plan and I executed it. So it all goes back to controlling those emotions, and the way to do it is to have that anticipation. I could be right, or I could be wrong, and if I'm wrong, I have to cut my loss. That's all there is to it. Otherwise, we've all been there. It's just a disaster.
And I mean, it's a psychological effect that pretty much humans have. When we have a winning trade, we like to take those off super quick because the ego,
Right.
we like to be right, and we just confirmed being right. And when we're wrong, we don't want to confirm being wrong. So you just kind of sit there and wait and hold, and then your loss is exponentially growing potentially. Something to that end, actually, that I'm a really big advocate of, and I'm actually curious if you apply any sort of version of this. It sounds like you do, especially with setting your stops or wherever you're going to exit. But I'm really a big advocate of setting profit and loss targets before you enter a trade, before the emotions are involved, and before all of that exists. It sounds like you do that when we're talking to the downside, right?
Right.
You talk about where your next support level is. Do you do any form of that when it comes to profit taking to know when to take a winning trade off?
Yeah. Here's how I handle winners. Is that one of what I consider one of my key strengths in the market is because I'm looking at multiple time frames, and it's not just the daily and the 30-minute chart. I'll go down to a 10-minute time frame. I'll go down to a 2-minute time frame when it comes time to entry.
Okay.
So one of my strengths is that I'm pretty right on my entries. That I'm going to know right away whether I'm right or wrong, because it's going to start to move. It's at the level where it's supposed to.
Right.
So when I enter at at a bigger size intentionally, because my timing is good enough that I know that's one of my strengths. I add a little exercise, but my intent is, as soon as it begins to rally, and generally, I don't know if you're familiar with pivot analysis, the floor trader pivots, daily pivot, R1 and R2, S1 and S2. I'll use those as my first level for taking a third of my position off. So again, if we go back to the stock that was 22.5, most likely daily R2 would be somewhere around $23.12, let's say.
Okay.
So I'll see it run up to daily R2, and I'll either sell some immediately there, because a lot of times that's the high of the day, because there's a lot of programs based around them. So I'll sell that first third right then and there, and I'll hold my 2/3 position. What I do with the balance is I then raise my stop up to my generally, right around my cost basis.
Got it.
So if I get stopped out on the 2/3 at break even, and I've taken 60 cents on the first third, it means that I'll be out of the stock with a 20-cent profit on average. So I want to be in a position of strength, and winners don't take care of themselves. It's about aggressive, money management once you're in them as well. If the stock continues to rally, I'll raise my stop. And what I'll often do is, let's say I get a nice end of the day push, it ran another $1.25. Well, I might set half of my stop below the midday low the next morning. The next morning, I'll set it below the prior day's midday low. And then I'll keep my stop on the other third at break even, at my break even cost. So now if I get stopped out of a third with this much gain, another third with this much gain,
right,
and down here I've got break even, I'm going to give that final third a lot more wiggle room, so that maybe I can hold it. If I don't get stopped out of the second third, I'll just continue to raise that one very aggressively up under the successive higher lows. And then the final third, I'll trail it with a wider stop, using, again, the definition of trend, but on a larger time frame, so that it might be I can hold the stock for 2 to 3 weeks and survive some of these 1.5 point pullbacks on a $25 stock now. And then I'll get stopped out at, let's say, $26.80 on that final third. And maybe I took, 60 cents on the first third, $2.80 on the second third, but I make $6 on the final third. It's worth holding that. And, I never regret selling the early pieces, because there's a lot of times where I will sell that first third for the 60-cent gain. I'll get stopped out of the rest at break even. And then I'll see the stock decline. It'll go down $1. And I got out with 20 cents profit. And to me, it's those incremental gains as well, and not letting them turn into losers really makes a big difference at the end of the year.
I think that last part really is huge, is not allowing winners to turn into losers. That's something I personally trade. I'm mostly a derivatives trader, so I trade options and futures primarily. But when I'm trading longer durations, I have a very different strategy. When I'm day trading, it literally looks almost identical to that, where I'll break a position either into thirds or quarters.
Right.
And I find literally the exact same thing, because a lot of times traders, again, think in this, like we were talking about earlier, fundamental analysis or technical analysis.
Right.
The trade is on or the trade is off. And they kind of forget to take a little creative license in there and to play with scaling more. A lot of traders, I think, are too black and white, and they think that if they exit, then they should exit the whole thing.
Yeah, I agree.
I really like that. So I wanted to talk a little bit more specifically about your technical analysis approach. Obviously, I was fortunate enough to get a lot of it from your book. But if you were to list out your typical trading time frame, because that last part actually surprised me when you said that, sometimes you might take a trade out with that last third, like 2 weeks or something. I wasn't anticipating that. What kind of time frames would you say you trade, generally speaking?
I like to think of myself as a swing trader.
Okay.
So if the stock allows me to. So most of my day trades are either I get stopped out of what I thought was going to be a swing trade right away because it violated my stop and I have to move on. So the market told me to day trade it. I do some day trades when I'm just sitting in there, there's an opportunity that's just so obvious that I can't resist taking it. But I prefer not to be a day trader.
Okay.
So I like to swing trade, and generally what the market allows me to do in successful swing trades is hold them. The sweet spot is really probably 3 to 8 days, somewhere in there. And then if like I said, I've got that final third piece, maybe I'll even sell half of that third. So now I'm down to 1/6 of the position. And I might try to hold that. I try to experiment with holding it for a month or 6 weeks. But what I find out is once I get beyond that 2 to 3 week period, I'm generally better just being stopped out rather than trying to hold for a bigger move. And of course, it's, depending on what phase of the market we're in right now. Growth stocks are getting hit hard. They're not bouncing. And the ones that follow through don't do so for as long. 3 to 8 days is, a longer term window right now for my trades, more of them. So when there's great, heightened sense of uncertainty in the market naturally shrinks my time frame. It's not that sometimes I'm thinking, well, the market's more volatile, so I'm going to be quicker to take a little bit off. I'm going to raise my stop, faster because moves haven't followed through. But a lot of times it's just the market tells me that. And that's the key, is to really be able to objectively listen to the market and, and truly listen, not just hear it, but listen and say, okay, the market's saying, get out. That's it. And then as I go through my, my stocks at the end of the day, I start to see, hey, there's more stocks here that look like they're ready to break down than I've seen in the last week. That's the market telling me something. I'm not finding long candidates. That's important information that the market's telling me. It's saying, hey, maybe it's okay to, do some smaller short sales. So it's all about trying to be as objective in listening to the message of the market as possible, and using the experience that I've accumulated over the last 30 years to, make sure I implement whatever plan I come up with, and not let my ego get in the way. There's still times it surprises me, Eric, that,
Of
you know,
course.
it doesn't happen very often, but once in a while I look at my account and go, wait a minute, who is trading this account today? That's not me. That's not the guy that I've trained myself to be in the market. I was an emotional basket case. I didn't do anything
Right.
right. I broke 12 rules today. What the heck? You know, where does that come from? It's bizarre.
It's funny you say that because another it's fascinating talking to other traders because you find so many commonalities because that's another big one for me is trying to impose what we want the market to do or what we think the market should do just leads to errors. It just leads to problems.
Yep.
And it's exactly like you're saying, taking a look at the market and seeing the best way for us to tailor our current skill set to interface with what the market is doing tends to be a lot more successful instead of trying to force things onto it. And another thing that I actually just did a video on this not too long ago is the concept of emotions, because a lot of people talk about this idea of, you know, trying to be like a machine or a robot. And I think that that just sets people up for failure because at the end of the day, we need to control our emotions with certainty for sure. We have to do
Right.
that. But you can only control them if you acknowledge they exist. And this idea of, you know, oh, I'm just going to follow all these rules. And like you said, sometimes, you know, throughout the day, you just have this other version of yourself pop out and you're like, who the hell's that guy? And you know, that's emotions at work. I think it's something that I've become really interested in tune with because the way that I keep trade logs is for especially for shorter term trades, I have like a couple note section that I have to fill out
Mhm.
and I'll read them. I literally go through this big annual review at the end of the year and I'm reading through some of them now and it's legitimately kind of funny because I can look at it and be
Yeah.
like, who the hell is that guy?
Yeah.
Some of them are really emotional. Um,
The more experience you get, the good news is that you recognize those periods quicker. You
mm,
recognize them during the day when you're down X P and L, and don't continue to fight and chase. You instead you know, hey, back off. You're exhibiting, you know, dangerous behavior to your financial well-being here. Back off, slow down, go for a walk, do something, get away from the screen for a while, go reset. And that's, you know, I think that human nature is always gonna, we're always gonna have some little self-destructive seed that if we let it ferment, it's going to turn into something stronger. But the key is to recognize it quicker and then take the preventative actions. That to me is, you know, it used to be that this alter ego would show up once or twice a year, and my big thing was that I would find a stock that's down too much, and I
right,
would buy just a little bit, you know, to test the waters, and then it'd drop. You know, let's say I buy 400 shares, but then it drops $3, and I'm looking at it going, well, I have to buy more now. I'm not going to sell at $1,200
cost
loss,
average.
and and then I'd, you know, puke it out at the end of the day for a $20,000 loss and go, wait a minute, I that's not how I trade. What
Right,
happened there? So now that doesn't happen on, you know, with as big a number. But I'm more in tune with catching it quickly and correcting it and saying, wait a minute, this is just stupid.
right,
Don't forget the times you did this and it cost you a lot. Just move to the sidelines, stop.
right. Yeah, it for me, I don't really day trade super frequently anymore. I actually fall into a more similar category to you, where I probably manage my trades within 20 days normally.
Okay.
But when I do venture into day trading, I've set like a couple hard and fast rules, one of which is as soon as I get stopped out like 3 times in a row on something, like
Mm,
that's just go do something else. That's it for the day.
yeah.
And it's just because for me, luckily, day trading isn't really the primary, you know, development approach that I have or income approach at this point. But I have learned that once I start having successive stops, then sometimes, you know, I get, well, I got to get this right. You know, I got to figure it out. And then all of a sudden, you know, it's just stupid mistakes.
Yep.
You mentioned a little bit, you know, obviously some important habits you've developed over time. And if you were to list out like maybe your top 3 or 5 habits that you've developed since you started trading to now, what would those be?
Number one, don't chase moves. I mean, it's so easy to get excited and feel that FOMO and chase stocks. Always ask yourself, where has it come from? Has it expended much energy getting to where it is? Where does it have the potential to go? Is it running into an important prior level of support that has the potential to become resistance? And think of it as fresh money. What's my risk reward here? If I was the guy who bought 3 days ago when it was 15% lower and it's now breaking out, it makes sense to sell some to the breakout chasers. So ask those questions. Where does it come from? Where does it have the potential to go? My habits are to, just continually, scan the market manually with my own 2 eyes, looking at, getting a better feel for the market by looking at a lot of stocks. Looking at stocks I know I'm not going to trade, but just saying, here are the themes that seem to be setting up. Yep. It's not that I'm going to scan and tell the market, here's a list of types of stocks I want to buy. Instead, I want to listen to the market. I have a general idea of what I want, and I could program that very easily, but I don't get the same feel for the market. So for me, I have to be in tune with the market. And, let's say I come back from vacation. Most likely I was looking at the market on vacation a little bit, but I often won't trade that first day because my feel isn't there. I haven't been involved with actual money in the market. I can look at the charts and know where we are in the overall cycle, but my feel isn't there. So I need to just, sometimes just slow things down a little bit and that's a habit as well. Just slow things down. You don't have to try to be involved in everything.
It's, again, just every once in a while I'll put a video out about, just some habits that I think are important, that looking back, and I really like the one you mentioned about slowing down, because a lot of people, I find myself, I literally this morning, I was like doing my morning workout and I was watching something and it started to move, and I was like immediately starting to place a trade. I was like, whoa, like chill out, dude. You're not even like, I didn't know if I had earnings coming up, anything. And I was like setting this trade up on my phone. And I realized like I still have that tendency sometimes where I feel like I'm going to miss something, if I don't jump in right now, that FOMO that you're talking about. So I think that cautionary tale in general of like slowing down is just really powerful.
Eric, just real quickly. I mean, I have those feelings once in a while too. I'll be looking at my phone, in bed going, what's the market doing? And I'll see something happening. But I try not to look at my phone or look at the market until I don't like to be in front of my computer at the most for more than an hour before the market opens, only if there's an economic event. But generally, I like to be in front of the computer about a half hour before the market opens, because sometimes I just get itchy and I know this about me, and I'll buy something in the market when I know I shouldn't. And those end up being mistakes more often than not. So to, prevent myself from doing that, I say, well, I'm not allowed to sit in front of the computer till 9 Eastern. Right. That gives me the ability. I can read my little summary newsletters and that sort of thing, but I can't let myself get in front of price action because I'm not good at trading in the pre-market, and it ends up costing me money. So I'm not allowed to do it. I don't allow myself.
Right. Yeah. It's funny because it is one of those things that I feel like over time you definitely learn to get a handle on. But it's interesting to hear, that the urge is still there for you. Cause I say it all the time. Oh, yeah. I say it jokingly, but anybody who actively trades, we all have a little bit of degenerate in us somewhere. Absolutely. In there. Yeah. We got that dude that just wants to get in there and just start slinging money. And it's important, obviously, keep that in its proper place because it gets out of control quick. So I wanted to ask you another kind of list of some of your favorites. But this one I wanted to pivot to kind of your favorite TA tools. So from your book, you actually do a like really, really great job outlining a lot of the tools that you like to use and the circumstances you like to use. Obviously a lot of talk about moving averages and
Right.
volume, things like that, which funny enough, those are probably some of the primary tools that I generally also use, which I think is just a indication of how universally they can be applied depending on, your
Right.
general trading approach. But I'm really curious if you were to give a handful of your must technical trading tools, what are those?
Obviously, price, only price pays. I had to throw that in there at some point. Price, volume, some moving averages, simple moving averages, whether it's simple or exponential is irrelevant.
Right.
Multiple time frames, anchored volume weighted average price, and the lower tiered ones, I do a little bit of Fibonacci stuff, just general retracements, pivot levels, as I discussed, and what else? Sometimes I'll look at a volume by price. Seldom, but sometimes I look at that. So the keys are price, multiple time frames, moving averages, volume weighted average price.
Got it. And just out of curiosity, how did you come across, how did the anchored VWAP find its way into your toolkit? Because I actually found that to be pretty unique to you. Other people will talk about it, but that also came through when I was reading some of what you talk about. And I found that interesting because a lot of people talk about VWAP, but not everybody actually ties it to an anchor. So how did that come to be?
Well, in 2003, I was trading on a platform called Realtick, and Realtick
Okay.
had, the daily volume weighted average price on there that
Mhm.
represented it as a moving average. It's not a moving average, but it represented like one on your chart. And then they had a trend tool called, that you could drag from left to right. It would show up as a horizontal line. And when I drag it across the screen, it would go up and down and it would keep hitting at prices. So it was actually a volume weighted average trend line it was kind of weird to analyze. But then I started playing with when I had the volume weighted average price on a chart, I realized that if I changed the time frame to like 10 minutes and went back 10 days, it would give me the 10-day volume weighted average price. So I would play around with the date and the time frame to see, hey, well, from that earnings report, I wonder what the volume weighted average price was. That was 13 days ago. So I'd have to just switch it to a 13-day view. And it allowed me to basically anchor from that point. So I started noticing how relevant it was to price action that institutions were either defending it or on the long or short side, and it became like a hidden point where buyers and sellers would show up. So I had kind of played around with that for a while and asked Realtick if they could build it as a tool that you could anchor from any point. They never did it, but TC2000 did about 5 years ago, and they put it on as the volume weighted average price by Alpha Trends. That's my handle. And now it's point and click, and it's on from that introduction about 5 years ago, it's now on about a dozen different platforms where you can very easily anchor from any point forward to understand who's in control with absolute 100% certainty from any point in time.
Right.
That it's not a subjective analysis tool. It's factual supply and demand.
That's fascinating. And what time frame do you normally like to use for your anchor?
Whatever's relevant. I will put them on a chart from 5 years ago where there was a significant high, and maybe it's undergone a long-term accumulation. It pops up, and you'd be surprised. It hits it to the T. It runs 20%, hits that VWAP from the peak 5 years ago, and then pulls back. I mean, it's crazy. So I'll look at them. I want to be aware of all of the time frames, generally speaking.
Okay.
Now, it's not often I go to the weekly time frame and look to anchor something, but if I can't find it on my daily chart, I want to be aware of what's on the bigger picture. Is there something there I should be aware of that has the potential to become support or resistance? The longer it's been out there, the less likely it's going to have current memory attached to it. But there's still people like myself who will look at it and decide not to buy because it's close to that, or to take some profits because it's close to that level. So intraday, I like to use it on my, 15-minute time frames or 30-minute time frames, so I can see the high 20 days ago and the low 8 days ago and how they converge together to form, a volume weighted average price pinch. And, you can see factually that transition from supply controlled market to demand, reaching that equilibrium, the battle, reaching the equilibrium, and then where demand retakes that control with, again, 100% certainty that the average price from that point, the buyers are in control.
Right. That makes a ton of sense. And then another question I have is, where do Fibonacci's fit into this? Because you were kind of mentioning that they're like a secondary tier. Where do those fit in for you?
A lot of times I'll just use them as again, second, tertiary tier level that I'll see the stock that goes from 28 to 35, and then it pulls back to the rising 20-day moving average. And I'll look at the 28 to 35 and I'll put a Fibonacci and say, hey, it's right there at the 61.8% retracement. So I want to look at it and say, what's the psychology of the rising 20-day moving average?
Okay.
The psychology is shorts will cover as it approaches that. Longs will, try to establish support for their bigger position in there. Sideline money will come in. Shorts will not want to short it. So it's a transition of supply and demand at this level deemed important by the market. A smaller piece is a 61.8% retracement level. When it pulls back there, the people who counter trend shorts will say, hey, we should cover it. It's a 61.8% pullback. It's still in a primary uptrend. Let's take our profits. A big institution will say, hey, it's pulled back 61.8%. We've got 5 million shares of this thing. We sold 300,000. Let's bid for 100,000 so it sticks in this level. Sideline cash will come in and say, hey, I'm a Fibonacci guy. I buy 61.8% retracements. So it's all about trying to determine how the psychology of supply and demand comes together through those various participants to form the basis of, hey, we're at an inflection level, potential support, because it's the 20-day moving average, because it's the VWAP from that prior low, and it's the 61.8% retracement. So we have three different groups of participants, long, short, and cash, coming together in the same area to find the same conclusion that, one, we shouldn't sell short, or if we were short, we should cover. If we're on the sidelines in cash, maybe we start to nibble, and just forms that psychology, the picture of supply and demand by understanding, the motivations of the participants.
Right. And then can you settle a debate? Do you like to draw your Fibonacci's from highs and lows or from close and opens?
Highs and lows.
Yeah.
I like to encompass the whole range. And same is true for the VWAP. I want to know the psychology of all the participants within that range.
Got it. That makes a ton of sense. Okay, cool. So I wanted to wrap things up, being mindful of your time. And one of the couple last questions I had for you is, obviously looking back 2020, 2022, just really unique time frame, in the markets, even from the COVID drop to the parabolic recovery. But I'm curious to get just your general sentiments, again, just looking through your paradigm at the markets. What stood out in 2021, and what was kind of something either that was impactful that you didn't expect, anything like that?
I think that there's, a lot of things you can look at in the market and learn lessons from. And to me, that it's just kind of reiterating what I kind of already know, that, to me, it doesn't make sense to buy dips, that people fall in love with names. Again, going back to some of these leaders that have been hit so hard, down 50, 80%. And people are stuck on Zoom and Peloton and PayPal, and the list goes on and on and on. So staying true to the trend rather than the story is what helps me avoid losing money more than anything. And then focusing on the stocks that are in those low risk positions. And to me, it's, I'm not a person who has grand, themes for next year. I think that they're kind of foolish to do for my time frame. I have the ability to be flexible. If my time frame is 3 to 8 days, why on earth would I try to project something a year out and say, well, my price target for the S&P this year, and I think these industry groups are going to lead or whatever. It's got nothing to do with how I put money into the market and move it in and out. So to me, it's always about staying true to the process, staying focused on being religious about cutting losers, position sizing, risk management, money management in terms of overall portfolio in one position. When do I hit the gas when the light is green? And when do I slow down and just nibble on things, on tester pieces to, I would still want to be involved in the stock, but the market's not really showing me good signs. So I'd hate for it to go without me, but I want to be involved without a lot of risk. So taking smaller positions and just being flexible, I think is what I want to be able to continue to do is to, I hate to repeat myself over and over again, but I want to objectively listen to the market as best I can and not force my opinions, but find those low risk, high probability setups, cut my losers quickly if the market tells me to, and do the best job I can holding as big a piece for as long as the trade lets me to.
Right, right. So you hit a little bit of kind of, your time frame that you like to look at. So don't have to go into specifics here, but for the last question, I am curious, when you're like just getting ready for 2022, what kind of things come into your mind? Obviously, not necessarily talking about price prediction, market drops, stuff like that, but just, when we're looking at the next year, what are some factors that you're integrating into that lens?
Well, I think it's more about, having my mind in a good place and being well rested and, not deviating from my plans and making sure that I've done the homework the night before so that I'm thoroughly prepared for the next day, that I'm staying healthy, that I'm, I've been doing it long enough that it's not about, hey, I need to read a new book about money management. It's about, am I holding myself accountable to the truths that I know, and not letting myself get distracted by something on, I don't watch CNBC because it doesn't help me. It in fact hurts me, and not because it's bad information, but it distracts me.
Right.
And someone will be talking about a stock. I'll pull it up, I'll be bored, and I'll trade it, and I'll lose money because I haven't done the work. Not letting Twitter become a distraction. For me, it's about tuning out the outside noise, making sure that my mind is in a place where I can perform at my best, making sure I know that I can execute what I know that I've learned through a lot of hard experience, cutting the same things we've been talking about.
Yeah, I actually really like that. I think that's like a great ending note, to focus more on your personal game plan and less on the external noise. Because
Yeah.
I think a lot of people get wrapped up in that, even myself included sometimes. I know when AMC was going crazy at the beginning of the year, and I wasn't participating. I was watching it very closely, and then I started nibbling, and the trade worked out, thankfully. But you know what I mean? That's exactly what you're talking about. I was definitely paying a lot of attention to external noise. A little FOMO came in, so I started
Right.
nibbling, but that can be dangerous. So again, that's the degenerate in me coming out.
Yeah.
He lives in there. But this, thank you so much for taking some time to chat with us. The perspective you bring, I really think it's fascinating, and I think it's something that a lot of people that follow at least my channel, are interested in, because I, again, have a certain lens that I apply to the market, but your lens also applies to a lot of people. And I mean, I'm even excited to learn more about what you do and your expertise. So thank you for taking some time to hang out with us.
Yeah, thank you so much, Eric, and to you and all the vets out there that have made sacrifices in ways that I can't begin to realize. So I appreciate that, and there's all kinds of ways to the finish line here in the market, and one of the things I would encourage people to do is to make sure that you find one that's truly suitable to your personality, and figuring out what your time frame is, and tuning out noise and just being as objective about the getting the results as possible.
Yeah, well, thank you, and we definitely, appreciate you taking the time to share what you know with us and your expertise, and definitely would love to have you on again one time. We were talking a little before about doing maybe looking at some charts and having you walk
Yeah,
us through, well, specifically walk me through, because I would love to learn, more about your approach and whatnot. I think that'd be a great time.
that's where I'm at my best, Eric.
That's all. Well, perfect. That lines up beautifully because I love being a student, so I'm looking forward to it.
Very cool. Thanks again.
All right, thanks, Bryan.